Getting started in large markets can be overwhelming and sometimes inaccessible. We're living through turbulent times as economic conditions are constantly changing, and working with clients who don't have the same experience can lead to a variety of problems. You need to avoid investing mistakes when there's your entire wallet and your heart on the line, or if you're a beginner. Luckily for you, Fortune Fastliner, in this video, we will go over the mistakes that new investors to stocks often make and what you might want to avoid if you want to succeed in investing. And this might help you avoid losing such money in the stock market. So sit back and watch this video till the end. While you're here, if you're not subscribed yet, subscribe to the Fortune Fastlane YouTube channel. Let's dive headfirst into that list. Number 1. Avoid buying into any company that may go bankrupt. When a company announces bankruptcy or plans to file for it, you should expect to lose the money you invested. It is important that you take immediate steps to close your position in this market. Avoid losing your money in the stock market by never buying or selling stocks before you research. You might not be aware of indicators such as an announcement that a company is going bankrupt. If a company announces bankruptcy, just don't move on it. You should definitely not trust them and you probably should avoid them. Here's what happens if a company says that they're going bankrupt. The stock's not going anywhere. With future contracts, an investor can buy low and sell high without having to know the future of the company. But the stock value goes to zero. Stock values plummet as they're dropping in case of bankruptcy. Avoid buying a stock without enough information from researchers or through a well-known brokerage firm to avoid losing money on gambles and penny stocks. If you decide to buy into a company's stock after hearing the announcement or during coverage of the announcement, then it's likely the public will lose faith in that individual share of the company and therefore the stock price may no longer be as promising. You can't tell if a company is going to stay afloat or not. When this happens, everything falls apart. Number 2. Avoid buying penny stocks from over-the-counter market. The key risks that come with trading on the stock market over-the-counter are twofold. 1. There's often a lack of reliable information about the company. 2. Over-the-counter shares are traded in thinly traded markets more commonly than stocks that trade on a national exchange. Over-the-counter stocks are tempting for investors since they offer many shares with little money invested, as in penny stocks for just a couple of bucks. Don't buy penny stocks from over-the-counter market. Look for stocks with a reputation or reputable exchanges. When researching a company before buying the stock in it, make sure it meets the requirements to be listed on a reputable exchange. Don't go looking in high-risk over-the-counter markets that are full of shady businesses because they are usually more dubious and risky. Again, when you buy into the stock, it's important to do your research. Stick to stocks on already respected exchanges such as NASDAQ or NYC when searching for your next investment opportunity. Number 3. Be aware of the message boards. While stock message boards give investors an opportunity to hear from other investors with a variety of resources available to help you profit from stock market purchases, there are many different internet communication ways from newsletters to podcasts to blogs. Those that involve trading and personal finance will still be a popular opinion for traders everywhere to interact and share information with each other on the largest scale possible. However, you need to be aware of the message boards on which you engage in conversation. Just because a website appears legitimate doesn't guarantee global credibility. When you're browsing these forums, you have to consider a variety of sources and not just what they are pulling out of their back pocket. This is quite relevant when considering whether to participate in any stock message board. This credibility and accuracy are always important before any conclusions are drawn. While the information can be believed provided by reputable sources, one must take tactics such as marketing into account when evaluating the content. It's important to you to remember that not all producers of the information are legitimate. Not all content is useful. Number 4. Day trading isn't worth it. It's important to note that day trading is a very risky investment that you should avoid, and there's a good chance you could lose your money. It requires extensive knowledge of not just the market but also yourself, is often fast-paced, characterized by sharp price changes, and necessitates monitoring everything from news cycles to new marketing trends. If you decide to do it, remember that it needs to be part of your overall financial plan. You have to think about what else the investments you are making with your day trading money might do, or how they might impact the rest of your investment portfolio. Also think about what your lifestyle might look in the long game. When it comes to investing, it is important to understand how to make most out of your investments by buying and holding them for as long as possible. It's common knowledge that meaningful returns are more likely over a long-term period versus small in-and-out investments. Never bail on investment because you set up a plan to double your money in a certain period of time. This is a big mistake that you might want to avoid. Keep in mind that sometimes waiting for the best or even just about what's most logical will be worth it in the long run. Day trading shouldn't be taken lightly. It requires discipline and very careful decision making. If you want to make some real money, we suggest that you should not take part in day trading. Number 5. Don't try to time the markets. One of the biggest risks involved with market timing is missing out on periods of exceptional returns. It's not wise to invest in a market that isn't profitable for your time frame. Traders often attempt to time the market, and they often unsuccessfully do so. Investors abandon a stock market plummet just because the cost outweighs the potential returns risk, losing money. It's challenging, even for veterans of the business, which makes it a frequent mistake. Some investors who want quick access to cash when stocks decline will put all of their funds in the money market. But this is a very risky strategy, since it may not be possible for investments to recover as quickly. For this reason, keeping a few stock funds in order to time the purchase into the market is helpful. It is much better for you to take a measured approach. Take some of your estimated profit each month, and then when the markets have recovered, invest in high-yield stocks. Number 6. Pay attention to the overall markets. Unless you are of average skill level in the stock market, you need to keep track of the overall market in which your investments fall. This is important during the good times when you become overconfident and make unrealistic claims. If you're going up 10%, the general market is gaining 20%. Then you did poorly. But then, don't be upset with yourself. If you are unsure where the market is going during a certain time, look at the overall market's average. This will give you an idea about whether your stocks or your portfolio would do well if compared to the general market's performance. You need to take into consideration the overall market, the general markets. Number 7. The red flag about dividend-paying stocks. Dividend stocks are not always the best investment. A company under financial stress which eliminates or reduces its dividend in order to fund itself over an extended period of time. Many companies advertise high dividend yields as a way to attract investors. However, while dividend-paying stocks might offer attractive returns on investment, they may not be worth looking at. If a stock is a dead knock to its share price, there's going to be stocks with dividend yields of 20 to 25%. That should be a red flag. There are warning signs that it could be a trap for certain stocks, like if you can see the dividend yield of about 20% or higher, stay leaving the stock before it becomes a trap, because if you get to buy it once at a low price and then regret your decision when you realize that the companies that pulled their dividends never paid them out again, and their shares plummeted, you could end up losing all of your money. Number 8. Failure to diversify. Don't place your eggs all in one basket. Well, that means you should not invest all of your assets into one company or security. That investment could go down and be unsure of the future for your portfolio. You might want to consider, if you're going to invest in only one stock or asset, consider diversification. Diversifying your investment can help reduce risk and get better outcomes over a longer period of time. By scouting different stocks and hedging your bets, you may be able to avoid catastrophic losses on certain investments. Keep an eye on how your assets and investments fluctuate. This tends to help you ride out any drops while maximizing gains during upswings. Finding a balance between investing and diversification can be tricky for most investors, but it's important if you want to maximize your chance of success. However, the best course of action is to consult with an investment expert if you are very unsure. Number 9. Observe the volume. You have to look at the volume when checking out a stock and make sure you aren't about to get tripped up into bad investments. The downside of no trading volume is that it is difficult to sell your stock at a profit, leading to lost revenue from full market exposure. It just means that volumes are the number of shares being traded on any given day, and you need to keep an eye on the average volume of the stock. If a stock has a low trading volume, it might not be enough for you to make a profit from it. You can get a better idea of whether or not the stock has room to grow if there are more shares in circulation. Then it isn't often a good buy. Number 10. Having an emergency fund. If you do not have an emergency fund, it might be a mistake or something that you need to consider. What do you do if you are in a tough spot and in need of cash? Usually, if you are looking for a source of money quickly and don't have an emergency fund handy, you sell some of your stocks to get cash. You end up selling them at the worst time possible with the stock price low and things not going according to plan because you didn't have enough emergency funds. Without one, you may already be in the financial position where you need help and your assets such as stocks and trading accounts cannot help in an emergency. A key takeaway is to keep an emergency fund in order to take care of unexpected expenses without sacrificing your financial well-being. If you need money soon without waiting multiple weeks or months for the opposite result, if you do not have emergency funds, your preference is to build that back up first before investing in the stock market. In order to keep your portfolio from losing value, avoid these common investing mistakes. The list that we have produced will help you be more educated when it comes to investing and can save you from big mistakes and even to regrets later on. Knowing what to do and how to avoid them, to avoid falling into these traps, develop a thoughtful, systematic plan and stick to it. Keep an eye out for investment mistakes. They may cost you money, and that's why it's important for you to avoid them before they ruin your financial well-being. Successful investing is not just about selecting the right stocks. It also includes avoiding simple mistakes that could undo all the work you've been doing. That's it for this video, Fortune Fast Laner. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!